Welcome to the UK-USA Transatlantic Tax Talk podcast, brought to you by Collier Bristow. I'm Aidan Grant, a partner in our Trust Tax and Estate Planning team. In this series, we explore the complexities of UK-US tax and estate planning, helping individuals and families navigate cross-border wealth with confidence. From wills and trusts to philanthropy and moving to the UK, we cover it all and always with a US perspective. Let's get started. Welcome everyone to Collier Bristow's US-UK podcast, a series in which I speak to professional advisors working in the US-UK tax and estate planning world about topics that interest them and that will hopefully be of interest to Americans in the UK. As ever, if you're a regular listener, please remember to subscribe to this series so that way you don't miss an episode. Today, we're going to look at tax compliance with my guest. What do you do if you realize you should have been filing tax returns, but you haven't been? Perhaps you've only recently discovered you were an American citizen, or you've been living in the UK for a few years and paying tax to the wrong authority. Well, today we're going to lift the lid on what can often be quite a scary topic, and we want to help you understand what you can do to get in front of the problem and why doing nothing is usually not a good idea. My guest today is Daniel Jaffe, partner at Jaffe & Co. and is a US-UK tax advisor here in London. I can say with my hand on heart that I may not know a tax advisor who deals more frequently than this problem with Americans. And so, Daniel, it is an absolute pleasure to have you here today. I hope this isn't going to sound like a sort of trite thing, but is this just a regular day in the office for you talking about non-compliant Americans?
Hi, Aidan. Yes, it's great to be here. And as you can imagine, tax isn't the best dinner party conversation topic. So it's good to have an opportunity to talk about what we do to a wider audience. And yes, I speak to people almost every day who are US persons living outside the US who either have not been filing any US returns at all, or maybe haven't been doing it properly, and or have not been paying tax to the right place. So this is a very common topic that we deal with almost every day.
I will say that the dinner party topic conversation, you are absolutely right. It doesn't make for the most exciting thing, but I find in my own experience, when it gets towards the end of the evening and I remember either you're a tax advisor or a lawyer, suddenly you become quite usul. And that's when quietly sidles up to you and goes, actually, I did have a question. Can I just ask you really?
Yeah.
And then you go, yes, of course you can.
Yeah. Yes, if they need help, then you're top of their list. But when it's general chit-chat, it's probably not top of anyone's list.
On to the general chit-chat topic for today. I want to sort of take this in two different stages. I want to look first at sort of US tax reporting 101. What are some of the really important things that everyone needs to know about if they are having to deal with the IRS and the points at which they need to be filing tax returns? And then in the second half, I want to look at the circumstances where maybe someone hasn't filed a tax return and, like I mentioned in the intro, how we get out in front of it. So at its most fundamental point, Daniel, if you can possibly summarize it, who has to file a US tax return?
That's a good question because many people don't realize, but fundamentally, every US citizen is by definition a US taxpayer, and US taxpayers are taxed on their worldwide income regardless of where they live. That doesn't mean that every US citizen worldwide needs to or should be filing an actual tax return, but that means that every US person is subject to the general US tax rules. And if they meet the normal filing requirements for needing to file, then they should be doing so. So if you're a single person under 65, the filing requirement or the threshold of income at which you need to file a return is when you have gross income from all sources of around $14,500. So
it's not high.
Yeah, which is not high at all. So basically, any person in full-time employment generally is probably going to be exceeding the filing requirement. And it should be noted that many people living over here who are U.S. persons, they might be married to someone who's a non-U.S. person, in which case their filing status is likely to be married filing separately. And the threshold or the level of income at which you need to file a tax return at that filing status is only $5 of income. So you could have someone who's a homemaker with a bit of interest income who's a U.S. person, and in theory, they could need to file a tax return. And there are also some other reporting requirements, particularly the foreign bank account report, which we can address more later on. But that potentially needs to be done by any person, regardless of age, if they meet the FBAR reporting threshold, then they need to file the FBAR, even if they're a toddler. So if that's the case, then someone else needs to do it for them.
Demystify something for me, Daniel, because I will accept that for the first part of my life, most of what I understand from the US is what I get from TV. And you have this impression from the American cultural sort of film and TV shows that you watch that everyone in America has to file a tax return and everyone has to rush towards whatever it is, the April deadline, and everyone gets their tax returns in close to that deadline. Here in the UK, most people don't file tax returns because if you are a regular salaried employee, everything gets deducted at source. Unless you're making capital gains that need to be reported, for example, or have other sources of income, most people don't really think about tax reporting on a kind of annual basis. Am I right that in the US, that kind of deducted at source PAYE style arrangement with the tax revenue doesn't really exist?
Well, they do have very strict rules about how much should be deducted and how much needs to be paid by a certain time, either with withholding or estimated tax payments. But yes, the whole sort of culture of filing and the setup is very different because in America, there's usually 10 other different things that you need to put onto your tax return to either claim or be taxed on in order to get to the right amount of tax that you really need to pay or refund that you should be getting. Whereas in the UK, as you say, the vast majority of working people probably just have the correct amount of tax withheld at source. And there aren't so many deductions and credits that you can claim in the UK like there are in America. So in the UK, the filing requirements, they're not as black and white as they are in the US, but the main ones are when now it's if you earn more than £150,000. It was 100,000 a couple of years ago, but then it increased. Or of course, if you're self-employed, or you have a certain amount of income that is not taxed at source or from outside the UK. So yes, on the whole, I mean, I don't know the actual figures, but I would guess that the vast majority of people in the UK are not actually filing self-assessments. But in America, virtually anyone who's working, or even just if you want to claim some credits, possibly you're going to be filing a return if you're in the US.
And this will go together with something we might discuss later, but of course therein lies part of the complexity because someone who is in the UK and maybe isn't aware that they should be filing a US return, maybe also isn't aware that because they're a US person and the IRS is expecting tax, they probably also have to be filing a UK tax return, if only to make sure they're claiming the available credits. People know, because I've mentioned on this podcast previously, that I was an American myself and I was a salaried employee working in the UK, but as a US citizen, I had the good fortune to be raised by an American who knew that I had a tax filing obligation, but I was in effect filing a UK tax return simply because I had to file a US tax return and I wanted to make sure that the two authorities knew about what I was doing in the other country. So sometimes the mere fact of having to file a US tax return also then has a direct impact on your obligation to file a UK tax return.
Possibly, yes. I mean, we do have quite a lot of clients who need to file US returns, but possibly don't need to file UK returns. But yes, on the whole, the regime is quite different in the two countries. And as you say, and I think we'll get onto more later on, but many US persons living in the UK or outside the US anywhere are not aware of what their filing requirements actually are. And I mean, I would guess probably off the top of my head, it's less than the majority are actually aware or doing what they're supposed to be doing. But many more people have become aware in the last 10 years or so because of stuff we'll cover later on. But yes, I speak to people almost every day who are not aware or have not been filing returns.
Let's assume that people are thinking about this properly and they are fully engaged. And I imagine the audience of people who are listening to this is probably has a higher correlation of tax compliant listeners than the average public. What does a US tax year and reporting year look like? I know in the UK we have our April 5th tax year end. The Americans go for the slightly more understandable calendar year end for the end of their tax year, don't they?
Yes, they do. Our job would be a lot easier and it would save the clients quite a bit of fees if the two tax years aligned, but unfortunately they don't. I mean, other countries have even other tax years. If off the top of my head, I think on Australia, it's the end of June, which makes it really fun if we have someone living over here who's a US person with an Australian rental property. But, you know, these situations arise all the time. And yes, it is a key part of our job, you know, to make sure the income is properly reported across both jurisdictions and across the time periods. And in fact, actually, we've just very recently submitted our response. HMRC have a consultation, or they had a consultation open about simplifying the reporting of non-UK income. I mean, they started off with interest income, but general income, and on what sort of calendar year or what sort of fiscal year basis that should be done on. So yes, it is a key part of our job, and it particularly makes it tricky in terms of aligning the foreign tax credits and just aligning the treatment of income, because if someone has, large increase in income, particularly in Q1 of a year, it can cause a slight mismatch in how the amount should be treated. But it's something that we deal with every day.
So putting aside the consequences in the UK and when and how you pay tax and by what date, etc., which I want to come to in a second, what is the standard US filing deadline for your tax return? From my perspective, every time I talk to an American tax advisor, there seems to be an impending US tax deadline. April 15th, October 15th, June 15th. Yes. I mean, there seems to be not a month that goes past without there being some sort of US tax deadline.
Yes, unfortunately, that's part of the job, is dealing with multiple deadlines plus the UK one. But as most people in America, I'm sure are or must be usually aware, the standard filing deadline and payment deadline in the US, if you're living in the US, is April 15th. And tax is all...
Which is three months after the end of the tax. We give 9 months.
Yeah, it's not long at all. So there's a major rush. If you're a US-based tax practice, your first 3 months of the year are not fun at all. But tax is always due by April 15th. So if you pay later than that, there's always going to be at least late payment interest charged. For clients or for taxpayers who are living outside the US, there's an automatic extension to June 15th without having to file an actual request to get that extension. And you also don't get charged late payment penalties if you pay before June 15th, but you're still charged the interest from April 15th. And if you file an actual extension form by your relevant deadline, whether you're in the US or outside the US, you can move your deadline to October 15th. And if you're living outside the US, and this is something that many US-based practitioners, as far as I can tell, are not even aware of, you can actually extend your deadline even further to December 15th. But that's for the regular tax return. There's also the foreign bank account report, which the deadline used to be June 30th. In the last 4 or 5 years, it shifted to being April 15th, but with an automatic extension without filing anything to October 15th. But no further extension beyond that. And on top of that, if you have certain filing requirements relating to foreign trusts, the deadline could actually be March 15th, and you need to file a different extension form for that. So yes, it's sort of fortunate in some ways that we have almost a whole year to deal with all the returns for all our clients. And some people send their information in to us second week of January. Some people are sending their information to us the second week of December. So, everywhere in between. So it actually does give us most of the year to get the work done. But then after that, we've also got the UK deadline of January 31st. Having said that, for US taxpayers, we always recommend or generally encourage any US taxpayer living in the UK, if they need to file the UK self-assessment, we strongly recommend that they do not wait until January to do that UK tax return. We recommend that they take care of it, or at least what they owe for the April 5th year, before the end of that calendar year. So, for example, U.S. clients ideally should be filing or should have filed their April 5th, 2024 UK tax return by the end of 2024. And critically, to pay the tax, if they do owe any tax, before the end of 2024, so that when they come to file their U.S. tax return for the tax year 2024, they are able to claim a foreign tax credit for that UK tax, because by default, and the vast majority of US taxpayers claim the foreign tax credit on what they call the cash basis, which means you need to have physically paid the UK tax within the US tax year in which you want to claim the credit. Otherwise, you either have to be on the accrued basis, or you may have to carry credits backwards from one year to the year before, but that gets complicated and expensive. So yes, generally speaking, even though you've got until January the following year to take care of your UK tax return, we've done the very vast majority of our clients' UK returns before the end of December.
I don't know enough about tax reporting in the US, but I know enough to be dangerous, which is whenever someone says cash versus accrued basis, my eyes start going slightly square. I know that accrued is the one that most clients in the UK are probably not better being on, and that most clients pay on the cash basis, exactly as you say. But is it not the case? So you made the point about the 31 December paying deadline in the UK, which I've heard tax advisors talk to me frequently enough about. That's fine for the tax year end ending 5th of April. So let's take, for example, when recording this down, you and I are currently coming towards the end of the 24-25 UK tax year, the final deadline for which will be 31 January 2026. And so for money arising in the current tax year, you want that paid by 31 December, like a month early, let's say. But for money that arises to me after the 5th of April in what is the UK 2025-26 tax year, but is still in the US calendar year 25, let's say, for example, I make a large capital gain in August this year, August 2025, that is. I wouldn't have to report that in the UK until the filing deadline for the 25-26 tax year, which is 31 January 27. You're going to tell me, I think you're going to tell me, that I might be better off paying that tax to the UK, given it arose in August. I might be better off trying to pay that tax to the UK by 31 December 25, which is like 13 months earlier than I have to, so that I can kind of book with HMRC saying, look, I've paid tax, and the IRS and say, look, I paid the tax in the right calendar year, albeit like 13 months early in the UK. Am I correct?
That's exactly right. Yes, Aidan. Yeah, that's exactly right. It can be the case, or it is often the case. I mean, we send an email to all our clients in October, November of every year to remind them or highlight the fact that if they have realized any capital gains between April 6th and December 31st, or have any sources of income where the tax has not been withheld at source by the right jurisdiction, and if they are going to need to pay primarily UK tax on that income, or any foreign tax on that income, then they need to estimate and prepay what that tax is going to be before the end of that calendar year, i.e. the end of the US tax year, so that they are able, when they file their U.S. tax return for that year, they're able to claim that foreign tax credit. And yes, worst case scenario is that they actually aren't aware or don't know and don't end up paying until the January 31st of 2 years later, which is fine if you're just a regular UK taxpayer. But if you're a U.S. taxpayer and if you had a gain in August of 2024, and you don't pay the UK tax on that until January of 2026, you can only carry foreign tax credits back 1 year. So you'd be in a bit of a pickle, and you may need to go on accrued basis potentially to try to recover the situation. But that has its pitfalls and its complications, and it's generally not advised. But yes, you could be in a situation where you need to pay tax many, many months early.
I mean, the most egregious I've seen this is, let's say, not say August, let's say it's a trust distribution or something, a large capital event, and the client gets the distribution in the beginning of December. Let's say they get the beginning of December 2024. They might still be recommended to prepay the tax to the revenue, like almost as soon as they've received the money in the UK. Because it's still a UK tax charge that has arisen in the calendar year 24. So if they get the distribution in early December, we might be saying to them, or you might be saying to them, pay that tax to the UK by the end of this month. So it's kind of booked in the right year, which is a huge exercise, a turnaround to get the distribution. God knows have to calculate the tax charge on it, pay the tax to HMRC, only for HMRC then turn around to you and say,
yes.
What are you doing?
Yes, I had a somewhat similar situation, a month ago, where I had a client who effectively a partner and was receiving a fairly large bonus on December 31st. And, it was going to be difficult for him to be able to pay the tax from there on that day. So we had to spend a fair bit of time making sure that it actually wasn't critical that he paid the tax because he had enough carryovers. Fundamentally, the US and UK foreign tax credit systems are quite different because in the UK, they look at, okay, what was your income and how much foreign tax have you actually incurred on that? or accrued on that, maybe haven't yet physically paid, but they just want to know what tax have you actually paid on that income. But that's all you can get credit for. And once you've gotten that maximum amount of credit, doesn't matter if you paid more tax than that, that's just all the credit you can get. Whereas in the US, they look at what's your foreign income in the year, what's the amount of foreign taxes that you paid in the year, how much credit do you need to offset the potential US tax liability on that income. And if you've paid more foreign tax than that, you'd have an excess amount of credits that you can actually carry forward for up to 10 years. And those can be very valuable in the future if you have some sort of income where it's actually not subject to foreign tax, or there's some timing differences or issues. But there's lots of rules and different baskets of foreign tax credits. So yeah, it's quite different regimes. There's pros and cons to each.
This is where we end up, am I right, with this scenario where lots of Americans living in the UK actually have a not insubstantial pool of unused foreign tax credits because, or if on the assumption that the UK rate of tax on, say, income is marginally higher than the US every year, then every year, as a UK resident, they're probably paying a couple of percentage points or maybe even more of UK tax. And that's going to cause this kind of growth in a unused foreign tax credit pool in the US. And then when they have foreign mortgage gains or large one-off events, they actually might have an unused tax credit pool that actually, unbeknownst to them, could actually be used to offset their tax and sort of dampen and smooth out the tax in a future year.
Yes, that's exactly right. And actually, even though the tax rates, the headline rates are not, the highest rates are not that much higher in the UK than the US, the big difference is that the higher rates of UK tax apply at much, much, much lower levels of income than they do for most taxpayers in the US. So yes, you can be accumulating tens or hundreds or millions of foreign tax credit carryovers. And yes, those can be very, very valuable. I mean, they will reduce your US tax one for one if you have some foreign income which is not being taxed in the foreign jurisdiction and you have the right type of credits.
So that all sounds, I say it sounds positive. If people can follow along with it, it can be positive. But there are obviously places where one needs to take great care and seek the appropriate advice of a US UK tax advisor. Let me take you to one other place which you have mentioned previously, but I want to just spend a little more time on this first half of the discussion, which is the FBAR. If we think about the ludicrousness of US tax reporting thus far, we ain't seen nothing yet. The FBAR, am I right, arises out of the US's sort of FATCA regime, which insists that America wants to know about everything everyone has everywhere all the time. And talk to the listeners, Daniel, about what threshold triggers an FBAR disclosure and what has to go onto an FBAR return.
Okay, yes. One slight correction is that, as far as I'm aware, the FBAR filing requirement is not a result of the FATCA law, which was in 2010 or 11, was part of the Hire Act. But yes, the FATCA law or the requirement for the FBAR stems, I believe it's from 1970. And as far as I understand, it was originally designed to make sure people were not using foreign bank accounts for illegal purposes like money laundering or financing terrorism and things like that.
An understandable aim.
Yeah. I believe, but it's worth us double checking, that the original threshold was when a U.S. person owned or controlled non-U.S. bank accounts or financial accounts which exceeded $5,000 worth at any time during the year. And it's only gone up in 55 years to $10,000 worth, which I'm sure if you really adjusted the original number for inflation, it should be substantially higher than that. But yes, but fundamentally, there is a filing requirement for any U.S. person if they own or control non-U.S. bank or financial accounts, even if they're just a treasurer of their tennis club and they control the bank account for that club. If the total value of all those accounts exceeded $10,000 worth at any time during the year, they are required to file the FBAR, which is actually physically separate from the tax return and doesn't actually go to the IRS. It goes to another place in the Treasury called FinCEN, or the Financial Crimes Enforcement Network. And yes, generally, I mean, it's not a tax return. It is an information return. But it also falls under the sort of purview of the IRS in some ways, and it is used by U.S. prosecutors to penalize people who have been hiding money from the IRS, because the potential penalties for not doing it can be quite extreme.
And I'm going to say sarcastically, because I know the answer to this question, this only covers bank accounts. This doesn't cover, for example, my UK pension, because my UK pension isn't a bank account as far as the IRS is concerned. He says sarcastically, please tell me why I'm wrong.
Yes, well, the definition of foreign financial account is quite broad. So anything that smells like a financial account should probably be reported on the FBAR. So that would be current accounts, savings accounts, ISAs, national savings and investments accounts, non-state pensions, pretty much anything. I mean, in theory, or strictly speaking, it could be a PayPal account if it's outside the US. So yes, it's basically anything that looks or smells like a foreign account.
I remember trying to file my FBAR when I'd just taken out my first mortgage and trying to work out how much was the highest amount that was in my bank account in any one year, which is, I think, what the FBAR requires you to do, was quite easy in that year because it was the iota of a second when the mortgage company had transferred the money to my bank account before it immediately went out to the solicitors who were helping me with the purchase. I was sort of slightly perturbed about the fact that the IRS, as far as they were concerned, saw that I had, hundreds of thousands of pounds in my bank account, which I absolutely did not. But as far as the FBAR disclosure was concerned, for that particular year, I had, 100 times more in that bank account than I would usually have. And I was concerned that the other regimes would go, hang on, where does this money come from? We'd like to learn some more about it. That never happened, I should hasten to add. But it was a particularly annoying year. It made me look wealthier than I thought I was.
Yes, a lot of people also ask, well, if I move money from one account to another account, it looks like I've got twice the amount of money that I really had. And I usually just tell them that's just what they need to report. And the IRS is not going to tax them on that. And it's just for information. And I've never, ever actually had any of my clients receive correspondence from the US Treasury about their FBARs. And we filed many, many thousands and thousands of them.
Long may it rain.
Yes.
You talk quite frequently to people who don't realize or haven't been filing tax returns. How do you run those conversations? Because you've got to kind of break it to people gently, but also not scare them away. It can't be an easy conversation to have.
Well, by the time they've come to us, I usually already have some knowledge or have come to the realization, although it may not be totally solidified, but they've usually got an inkling or an awareness that all US persons, all US citizens are subject to these rules. So I'm usually not breaking the sort of headline news to them. However, when we get into the details, some of it can be quite surprising and shocking. And I have had several conversations with people crying on the telephones, but usually it works out a lot better than they initially feared. And hopefully it's just a compliance exercise and they don't owe a substantial amount of US tax. But yes, it can be quite a shock when people discover the general situation. And yes, there's many, many people out there who are still probably not aware or who have become aware in the last 5 or 10 years. But yes, it's something that we deal with virtually every day, or sometimes even I speak to more than one person in a day who's in the situation.
I realize then actually what you've referred to there is that maybe I'm the one who has to break the bad news to the clients because I'm the one that then sends them to you and you then get to
sometimes, yeah.
The knight in shining armor. Yeah, so maybe I have to have a conversation with the clients, and I have definitely had conversation with clients where they didn't realize these issues.
Yes. I can imagine that, yeah.
Yes. So before actually sort of getting into and drilling down into the accidental Americans and their tax reporting, it is really important just to sort of clarify and reassure what you said previously, which is that if you are an American citizen in the eyes of the US government, then you are a US taxpayer in the eyes of the IRS. And there is an entire 2-part episode I did with 2 attorneys at Nixon Peabody, Chantel Randy and Alex Crean, looking at accidental Americans from a US legal perspective. And I encourage anyone who has any inkling that they might be an American or know an American that maybe doesn't know they're an American themselves to go and listen to that episode. We're going to presuppose a level of knowledge about what an accidental American is for the purposes of this discussion. My question to you, Daniel, sort of first off is, let's say I'm an American in the UK or I have an American child and that child is small and has no exposure to tax per se. From what you said in the first half of this discussion, the simple fact that they are an American doesn't necessarily trigger an obligation to file a tax return because they haven't met that minimum income threshold. That's the sort of the first point I wanted to reiterate.
Yeah, that's exactly right. Just because you are a U.S. citizen doesn't mean you need to have been physically filing U.S. tax returns, because you only need to file something if you meet the normal filing requirements for doing so. A lot of people actually have been vaguely aware of U.S. requirements, but they think that if they earn less than 100,000, or it could be 80, 90, or in that region of income, they think they don't need to file. But what they're actually confusing is the foreign earned income exclusion with the filing requirement. You could be earning up to, it's around $120,000 now, and you can exclude that amount of foreign earned income from your U.S. tax return, so you do not owe any U.S. tax on it. But even if you earn less than that, and it would all be excluded, doesn't mean you don't need to file a tax return. You need to file the return if you meet the normal filing requirements, which generally depend on what your filing status would be, which is generally determined by what your family and marital situation is. So if you're a single person under 65, it's if you have gross income from all sources of around $14,500. If you happen to be a U.S. person married to another U.S. person and you file jointly, it's substantially higher than that. It's around double, basically. But if you are a U.S. person and married to a non-U.S. person and you're not able to claim or to be head of household, then you would file as married, filing separately. And the filing requirement is gross income from all sources of only $5, which is obviously incredibly low. Another thing to be aware of is if you are self-employed, generally speaking, if you have net self-employment income of more than $400, then that can still trigger a need to file, even if it's less than the regular threshold. So yes, bottom line is every U.S. citizen is by definition a U.S. taxpayer, but not every U.S. taxpayer needs to actually be filing a U.S. return. But another category of persons who need to file U.S. tax returns living outside the U.S. is green card holders, who are also generally subject to the same U.S. tax rules as U.S. citizens. There are a few little differences, but even if your green card has lapsed for immigration purposes, unless you have filed the I-407 with the State Department, or you've had it, I believe, judicially or administratively revoked by the U.S. government, you are still considered to be in the U.S. tax system. So we've dealt with several people who have just been green card holders and haven't been filing what they're supposed to be filing.
Does that get affected by, so when I think about green card holders from my perspective as a UK lawyer, the first question I always have about green card holders is whether they've held the green card for more than 7 of the previous 15 years, I think, which gives them exposure to US estate tax. If that person has had a green card for a couple of years, but is now outside the US, does that US income tax reporting liability still track them outside the US if they've only held their green card for a couple of years?
It does if they still have it, if they've never revoked or abandoned, if they never formally abandoned the green card, then it doesn't matter if they were only in the US for 2 years on the green card. If they've now left the US, but still hold the green card, or even if it's, like I said, even if it's not valid for immigration purposes, but if they've never filed the I-407 or it's been formally revoked from them, then they are still in the U.S. tax system. Furthermore, if a green card holder, which the formal name is just a lawful permanent resident, if a green card holder has held the green card in 8 out of the previous 15 tax years, then if they then abandon the green card, then they are treated the same as a U.S. citizen who gives up their U.S. citizenship. In other words, they are potentially subject to the exit tax and all the rules that involves.
Which we might come on to later. So let's imagine ourselves, let's put you in a really unusual position, Daniel. You've been approached by an American who has just realized that they should have been filing tax returns, but haven't ever filed a tax return. Just let me ask you to struggle to conceive of a time when you've had to have that discussion. What does that American need to know about how to bring themselves into compliance? What is the procedure by which they bring themselves into compliance? How many years back do they have to go? This is your open forum to explain, to reassure people about how that process works.
Okay, sure. So for the majority of the clients we deal with, they're usually U.S. citizens who are living in the UK and may have been living in the UK for decades, or even just for 5 years, but have not been filing what they're supposed to be filing. So the usual prescribed method or process or procedure for those people to become compliant with the IRS is by filing through what they call the streamlined foreign offshore procedures. And to use those, or when using those procedures, you usually file tax returns for the last 3 years for which the due date has already passed, and file the FBAR for the last 6 years for which the due date has already passed. At this point in time, if someone came to me today, they would need to file tax years 21, 22, 23 of the Form 1040 tax return, and then the FBAR for years 2018 to 2023. And then, of course, now at this point in time, the 2024 tax return and FBAR are due on time. So it's a very commonly used process or procedure. And in order to qualify for the procedures, generally speaking, you must not have had what they call a U.S. abode, which generally means your main home. You must have been physically outside the U.S. for at least 330 full days in at least one of the 3 late tax years. And this is a criteria which confuses a lot of people. It basically means you cannot have spent more than 5 weeks in the U.S. in all of the 3 years. But as long as you've been outside the U.S. for those 330 full days in at least one of the years, then you'd be okay. And the other main criterion is that your non-compliance needs to be due to what they refer to as non-willful conduct. And fortunately, they define that quite generously as conduct that is due to negligence, inadvertence, or a good faith misunderstanding of the requirements of the law. So fortunately, that is a much more generous definition than the usual notion of having reasonable cause, which is what you normally need to claim or have when you are trying to tell the IRS not to levy penalties on you for doing something wrong, because the IRS definition of reasonable cause is much stricter and much less generous than non-willful conduct. We have filed, I haven't counted in a while, but we must have helped over 500 clients or so file streamlined submissions. And with the cases we've taken on, we've never had any of those cases questioned by the IRS in terms of why someone was not filing. Of course, if I thought someone was willfully not filing, I would send them on their way to a U.S. tax lawyer. For the clients we've dealt with, it can be people that either, they may have been born in the U.S. and left when they were even just 6 weeks old and didn't have a clue about U.S. reporting obligations until they may have received a letter from their bank relating to FATCA, as you said, and that alerted them to this whole situation. And then they frantically call us up and we tell them what the situation is. Or it could be someone who was filing U.S. tax returns, but did not report all their foreign income properly. Or it could be someone who had been filing tax returns for 10 years and for some reason stopped doing so. But generally, as the definition says, as long as you were either negligent, inadvertent, or just misunderstood the rules, then you should generally be okay. In other words, as long as you haven't been deliberately hiding money in a Swiss bank account, in my experience, it's unlikely that you'll have an issue. But unfortunately, the IRS does not actually even send you a confirmation that they've received your tax returns once you filed them, or the FBARs. They don't send you any confirmation saying, thank you very much. We agree that you meet the criteria for the streamlined procedures and it all looks fine and your behavior was non-willful. Basically, no news is good news. And I've never had any bad news on any client, fortunately.
That shows what a good tax advisor you are, Daniel. But I do think it's probably just worth pausing and sort of reiterating that point you made, which is for most clients who discover their inadvertent non-compliance, they only have to go back 3 years, not including the one that might still be in time, so the 2024 one in that scenario. And if they are a person who, let's take probably the most common example, they are a salaried UK employee, so their source of income is a UK source income, and so the UK tax is in practice, tax is paid to the UK anyway. Am I right that compliance exercise to the IRS would be saying, really sorry, here are my US tax returns, but in any event, I was always supposed to have paid the tax to the revenue in the UK anyway. So it's not like I should have paid you tax, IRS. Therefore, what I'm in effect sending you is a tax return belatedly claiming the credits that I should have claimed at the time.
For people, yes. For people who had simply UK salary taxed at source as normal, it is extremely unlikely that they will owe any US tax. And if that is their case, then they should owe zero tax. And in general, anyone living in the UK and paying normal rates of UK tax on their income, as long as there's been no timing issues, they generally should not have a US tax liability unless they have investment income and their total income is above a certain amount. They can get caught by what they call the net investment income tax of 3.8%, but that is a whole other podcast in itself, I'm sure. So yes, generally speaking, for UK resident clients, it's unlikely that they'll owe a significant amount of US tax or even any US tax. However, there are various different events or types of income which can result in a US tax liability, some more significant than others and some more common than others. These generally tend to be if you have income from an ISA or you have gains of certain types of assets which are not kosher for US tax purposes. If you potentially have had a very substantial amount of UK tax relief for various different things and not have enough foreign tax credits, you could have things like EMI gains, which are taxed at lower rates in the UK, but higher rates in the US. And if you don't have enough foreign tax credits in the US, you could have a problem. Could be potentially, this is one that catches out some people and caught out Boris Johnson, although possibly he didn't get great advice. But the sale of your primary residence is usually totally tax-free in the UK, but it may not be in the US if your gains are larger than a certain amount. So yes, there are certain things which can cause a US tax liability, but for a very simple, straightforward PAYE salary earner, it's unlikely that they will have a US liability.
So framing it this way, and maybe this is the last thing that we linger on, there are maybe three different outcomes to that kind of filing. You've either paid the tax correctly into the right jurisdiction, so you paid your tax to HMRC correctly, so you're just telling the IRS, here's the return, sorry, but I'm claiming the credit belatedly. You've got, I didn't have tax to pay in the UK because it was relieved or whatever, and so now IRS, I'm really sorry, I'm paying that ISA income tax to you already, or, the gain on the sale of my main residence, I'm now paying to you, but there was never a tax in the UK. Presumably the most complicated scenario, and I'm not going to ask you to unpack what is a complicated scenario, is if I've paid tax, but I've paid it to the wrong authority. So I paid tax to HMRC, should have been paid to the IRS. Presumably, the IRS is still going to want their money, and HMRC may not necessarily let go of the money you've paid them.
Yes, I had a conversation just last week with a lady who was in tears because she had inherited an IRA in the US and she had been drawing out the amounts over the last 5 or 6 or 7 years. She was paying full US tax on it, and she had a US tax preparer who unfortunately did not know any better. But unfortunately, given the amount of time she'd been in the UK and the fact that she'd been bringing the money into the UK and the fact that under the US-UK tax treaty, if you are drawing on a US retirement plan as a pension in regular amounts, you are subject primarily to UK tax on that income. She should have been paying UK tax on it and then claiming a credit on her US tax return. And this is where things can get a bit tricky. She might be okay in the end based on certain quirks of foreign tax credits. But if I had another case where a gentleman was drawing on a US annuity and it was an unfortunate situation because he had to pay UK tax on it. And in the end, it wasn't really cost effective to try and go really, really deep into it on the US side, but effectively he ended up, unfortunately, just paying tax. He had already paid the US tax, and it's difficult to recover from the US if it's more than 1 year back, or if you weren't on the accrued basis already. If it's worthwhile, you can speak to some US tax lawyers and try to dig a bit deeper and see what you can do. But yes, it can be a very unfortunate situation. And the UK's regime for becoming compliant, if you have not paid proper UK tax on your non-UK income, it can actually be, or generally substantially more onerous than the US streamline procedures. In the UK, they have the worldwide disclosure facility. But in theory, if you had not filed any UK tax returns at all, you could potentially even need to go back up to 20 years. But in practice, it's usually less than that. Well, if you've been filing tax returns, it's usually a lot less than that. But the penalties for some years, if you need to file April 5th, 2016 or prior, the penalties can be at least or are generally at least 100% of the tax you owe if the income is coming from the US. For subsequent years, you may be able to get it down to minimum 10 or possibly 0%, but it's usually between 0 and 30% if it's income from the US. But yes, you could end up having to file back to April 5th, 2014, or even prior years if you hadn't been in self-assessment already. So the UK system, I mean, if someone comes to me and they've been doing it wrong on both sides, I actually tell them arguably, and that is the case sometimes or quite often, if someone is in that situation, arguably, I mean, they should handle both sides, but it's HMRC, in my experience, who are more likely to be sending them a letter saying, we think that you've had some foreign income that you haven't reported properly. You know, you may want to use the Worldwide Disclosure Facility to report that. I think we even had a client, I think it was a New Zealand rental property that had been sold in recent years, and they had had it for over 10 years and had not been reporting the income. And somehow, I mean, there's a common reporting standard nowadays where other jurisdictions are reporting to HMRC and to the IRS, and FATCA was the initial one. It was the Foreign Account Tax Compliance Act. And that, to my knowledge, which is not in depth, but to my knowledge, that's what sort of triggered or kicked off all this information sharing between jurisdictions. And so it can be surprising sometimes what HMRC has picked up. On the US side, I've not yet spoken to anyone who had a letter from their bank saying, we think you're a US person, please give us your social security number. And they've done that. And then a month later, the IRS has sent them a letter saying, where's your tax returns? That has not happened yet. Presumably, that is the ultimate intention of FATCA, which is for the IRS to look at all the information they've received and to say, oh, we see Joe Bloggs living in Kent, who's a US person, has had all these foreign assets and hasn't reported the income to the US. I mean, it's more intended for people living in the US, but it will capture all, you know, it will be as relevant to all US persons. So to my knowledge, there are some tax advisors out there that do try to scare potential clients into signing their engagement letters on the day saying, if you haven't engaged me by tomorrow, the IRS knocks on your door, then bad things will happen to you. But in my experience, and I've spoken to, you know, multiple thousands of people who are not compliant, I've not seen that happen yet. But, you know, if you're not compliant, you should become compliant. And it's arguably the FBAR, which is more important for an expat, because generally speaking, for late filing of a regular tax return, you only would owe penalties if there is tax owed on the return. Whereas for the FBAR, there's potential penalties just for being late. You know, they can be significant, especially if the IRS thinks you are willfully late. Within the tax returns, there are also certain reporting requirements which can carry potential penalties for being late, even if there's no tax owed on them. One of those forms is the FATCA forms, the 8938s, which are similar to the FBAR, but they cover slightly different types of assets and are filed as part of the actual tax returns. But there's also reporting requirements for controlling a foreign corporation or a foreign partnership or having connection to a foreign trust. And yes, these things can carry fixed dollar penalties. But in our experience, or in my experience, we've never had any penalty situations with any such forms filed through the streamline procedures. So as long as you qualify, you should hopefully be okay.
If that isn't an advert for your business, I don't know what is. It is worth pointing out, I certainly intend, sitting here today with you, Daniel, to do a separate episode on non-compliant Americans who have not filed UK tax returns using the WDF and thinking about the HMRC compliance process. So you teed me up quite nicely. Thank you so much for your time today. I really, really appreciate it. That was chock full of so much information for people. If anyone is listening to this that is interested about US-UK tax planning, but is not US compliant, where can people find you?
If you just Google Jaffe & Co, will come up straight away, or you go to jaffeandco.com, or even if you Google US Tax London, we should be one of the first places that show up if you forget our name. So yes, we should be pretty easy to find.
I do love that search engine optimization and making sure that you appear just that little bit above your competitors.
Yeah, I mean, fortunately, we don't actually pay. I don't pay for any SEO. We've just been around a long, long time, and I guess we've got good links from other sites and good content. So yes, fortunately, we come up quite high, which is good.
Marvelous. Daniel, thank you so much again for all of your helpful and sage comments. And thank you to the listener for staying with us today. Please do join us again next time. My name is Aidan Grant. This has been Daniel Jaffe of Jaffe & Co. Thank you very much.
Pleasure. Thanks for having me.
That's all for this episode of the UK-USA Transatlantic Tax Talk podcast. Thank you for listening. If you found this discussion helpful, don't forget to subscribe wherever you get your podcasts. If you have suggestions for a topic for us to cover, then we'd love to hear from you. For expert insights and tailored legal advice, visit collibristow.com. We'll see you next time.